Famous economist Jim Rickards has identified a new problem that could be even scarier than the current economic issues. He believes it's the worst nightmare of bankers. The Federal Reserve has been raising interest rates rapidly, which is causing problems, but they have always said they can control inflation by doing so. However, they don't know how to stop deflation, and raising rates would only make it worse. They could go down to zero, but that won't help. QE or quantitative easing has been tried, with $9 trillion spent, but it hasn't worked. QE involves buying bonds, but the evidence shows it's not effective. And now let's discuss Jim Rickards' thoughts on what could be the biggest financial crisis in history and how you can safeguard yourself from it. Hey there friends, welcome to Capitalista. Before we start, please give a quick click on the like and subscribe buttons down below, and let's get started. The banks receive money from the Fed but keeps it as an excess reserve instead of using it to stimulate the economy. Lowering interest rates to zero won't help either. Negative interest rates were also tried in Europe, Switzerland, and Japan, but they didn't provide any benefits. The problem with deflation is that it feeds on itself and gets worse, and there's nothing the bank can do to fix it. Jim Rickards says this is the banker's worst nightmare, and we saw it happen during the Great Depression under the Hoover administration. The situation in 1933 was similar to the one in 2008. Jim Rickards says that when Franklin Roosevelt became president, he faced the same problem as the 2008 crisis. He closed every bank in America with an executive order to break the banking panic. If a similar situation were to happen today, it would be unimaginable for a president to order the closure of all banks. However, this didn't solve the deflation problem, and the Fed couldn't do anything about it. Jim Rickards said FDR found a way to beat deflation even when the central banks couldn't. And he did this by raising the price of gold. He made the dollar worth less than gold and raised gold's price by 75%. This made getting the price of other things like corn, steel, and oil easier. It worked during the Great Depression from 1933 to 1936, and the economy improved, but it was still low. The Democrats even had a song about how happy things were. Then in 1937, the Fed caused another recession. Deflation is a big problem that causes real interest rates to go up and feed on itself, and raising the price of gold was the only thing that worked. Now, according to Jim Rickards, owning gold is one reason to consider during a global recession, which is quite rare. Normally, suppose a country like Germany, Japan, or the US falls into a recession. In that case, there's usually another economy or group that's doing okay or better and can help pull everyone out of the economic slump. However, when all countries are in recession like what happened in 2008, it becomes more challenging. Unfortunately, that's the situation we're facing now. The US, Japan, Europe, China, and even India are all experiencing tough economic times, and this is mainly due to issues related to the dollar. Many countries like Switzerland, India, China, and Japan have experienced a decline in their US dollar reserves. It's often assumed that they're ditching the dollar, but the reality is they need more dollars. This is why they're selling treasuries to acquire dollars to rescue their banks, as there's a scarcity of dollars. Jim Rickards says that the countries selling off their dollar reserves doesn't necessarily mean they don't like the dollar. It just means they need more dollars and are selling off treasury securities to get them to support their own banking systems. This could lead to a global recession. This is because the US dollar is the benchmark for other currencies and a threat to all economic systems. About 60% of global reserves and 80% of global payments are in dollars. In addition, when people discuss the euro or other commodity currencies, they usually refer to them in dollars, like saying it's worth $1.05 or $4 in gold. This is because the dollar is the primary currency used in world markets, even for commodities. This shows that the dollar is an essential component of the global economic system, and its decline may be a factor in the current instability. As for the optimal asset allocation method, that would depend on an individual's financial goals and risk tolerance. Jim Rickards believes that diversification is crucial when it comes to investing. People often think they are diversified when they own multiple stocks in various industries. However, that's not necessarily true. Owning stocks from different sectors still counts as one asset class. These stocks can become highly correlated during challenging times, moving up or down together. Therefore, owning many stocks or ETFs does not guarantee diversification, and simply having multiple investments in one asset class is not real diversification. To achieve true diversification, one should consider investing in 10-year treasury notes, or if that seems too risky, perhaps a 5-year or 2-year note instead. These notes provide security in terms of credit. In the event of deflation or decreasing interest rates, investors can expect good returns in terms of capital gains or coupon payments. Jim Rickards suggests investing in income-producing real estate such as multi-family housing, residential real estate, and farms to generate a good amount of cash, possibly up to 30%. While some people may not like holding onto cash due to its low yield, it is a safe option during deflation and provides a balance against leverage. Although commercial real estate may not be a wise investment at the moment, these types of real estate can be a reliable source of income. Holding cash in your investment portfolio can help reduce the portfolio's overall volatility. Cash is like a bar connecting two ends of a barbell with very low volatility. Additionally, cash provides optionality, allowing investors to take advantage of buying opportunities that arise when markets crash. Warren Buffett, for example, has over $130 billion in cash, which shows that he understands the value of holding cash in uncertain times. Jim Rickards suggests that in the event of a market meltdown, it may be a good time for those with cash to invest in bargains. It's wise to have a portion of your investment in gold as a hedge against inflation, but only around 10% private equity can be a separate category to consider if good deals are available. For a model portfolio, it's recommended to have a portion in treasury notes and cash, some stocks, and a focus on energy such as BP, Exxon, Mobil, and Shell. However, until then, relying on oil and natural gas is necessary, which means investing in those companies can be profitable. Along with real estate and gold, a diversified portfolio of 5 or 6 asset classes can outperform others depending on economic situations like inflation or disinflation. With so much uncertainty, cash can act like a thermostat, allowing one to adjust their portfolio by buying more gold or stocks if necessary. So, do you agree with Jim Rickards? What are your diversification strategies during a market meltdown? Share your thoughts with us in the comment section down below. That's it for this video. Don't forget to express your gratitude by clicking on the thumbs up button, following our channel, and enabling notifications to stay updated and won't miss any of our future posts. See you next time and stay safe.